Welcome everybody to the third in our webinar series devoted to investment portfolio matters. We're looking forward to giving you further transparency in terms of what's going on within your portfolios, but also giving you a lot of information about what's going on in the markets and what we see. We have a very packed agenda today, and talk a little bit about what's going on with the firm. All of us are well. We're operating well remotely, and Carrie Doggett, our Chief Operating Officer, will be giving us a report as she has in each of our priors. In our agenda today, we're going to be getting that update from Carrie. We'll be going to specific information as to our operations as well as those of the custodians and all of the matters which affect our clients, money movement, account transactions, and the like. So she'll give some good detail there. We'll also then be going into our investment update. Mark McCarron, our Chief Investment Officer, will be giving us a market update through April 3rd, which is today. We're recording on Friday, April 3rd. So we'll have a perspective of what's gone on in the last week, as well as what's gone on through this whole crisis period. Mark will also be giving us the equity portfolio framework and perspective, how the portfolio is built out on the equity side, as well as our perspective of what the portfolio now looks like and how it may continue to evolve. Then we have a really terrific discussion between Mark and Kim Scott, who is the manager in our IB investments, IB fund inside of our portfolio. Kim is the Senior Vice President and has, as you'll learn a little bit more, has been in our Wescott portfolios for over a decade, and it's been a terrific performer. A few words about what's going on here. We've been really working a lot on client engagements. We've been having conversations and communications. We've been doing a lot of projections and other matters concerning things that are planning related as well as portfolio related. As you know, there's a lot of things that we've talked to you about both in emails and in prior webinar sessions, which led to portfolio action. This week, we also had an email on Wednesday, which was a detailed information regarding the CARES Act, the tax act that passed, the $2 trillion tax act that passed for stimulus and had a lot of impact on client portfolios and clients generally in terms of their own planning. So that email both described what the tax act was and also pointed out areas of planning and actions for us to take. So we're now in the proactive area, reaching out to see how we're going to be able to accomplish some of the planning that we can do, and are beginning to reach out to clients and their accountants for things that will be beneficial for them. We also worked this week on tax loss harvesting. You will have heard from your advisor if we were able to go in your portfolio and make some trades which freed up some losses against future gains, which I'm sure we'll have. So this was a proactive opportunity to bank some of the losses for the future, and using those proceeds to buy essentially a very similar security. So we maintained our market position. We're at the close of the first quarter of 2020. What a quarter it's been. Mark will talk about that too, but also takes us into a portfolio review time, reporting, and Carrie will give us some information about what's going on there. So with that, I would like to turn it over to our Chief Operating Officer, Carrie Doggett, who can give us more information as to what's going on inside of Wescott and our world. Thank you.
Great, thanks, Grant. So we've been up and running now in this remote environment for about 3 weeks. And all indications are that this is the way we're going to be doing business for at least another month. So the team is feeling settled into their new norm, and they're doing a great job supporting each other. We've got great partners in our custodians, and with the team environment and with the support of the custodians and other business partners, we haven't experienced any issues with trading, money movement, account administration, or other operational processes. Additionally, I'm really happy to share that we have had an increased number of clients adopt technology solutions, such as mobile check deposit or electronic signature of key forms, and the feedback that we've received from them has been really positive. So in a time of significant change, it's been nice to get great feedback on these channels, given for some of our clients, this is a change in how they've done business with us historically. Additionally, many of the client meetings that would have taken place face-to-face have now been executed through video conference. So of course, much of the world is really getting used to video interactions with friends or extended family, and we're happy that this channel is working very well for our relationships, many of our key relationships. The last point I'll make, you mentioned in the opening comments that we just ended the first quarter, and with that comes quarterly client reports that include holdings, performance, in addition to the quarterly market commentary that comes out of our investment research group. So the operations team, the advisors, Mark and his team are all working together to produce those deliverables. The quarterly reports are going to be available in our secure document exchange and storage system, which we refer to as My Wescott Vault. Many of you are familiar with the Vault and its capabilities. For those who would prefer, we can also send the report through an encrypted email that would come from your advisor. For the few clients who still receive paper copies of these reports, your advisor will reach out to you and we can discuss the alternatives. So with that, I'll turn it over to Mark for our market update.
Thank you, Carrie, and hello, everyone. So this is another update on the market. It's moving fast, of course, but we wanted to give you a real, highlight and update on what's going on in markets and the economy. First and foremost, what we have experienced the last 3 weeks at Wescott, which is working from home and shelter in place, has been a part of the temporary shutdown of non-essential activities, not only in the US, but globally. This will result in a global recession. And we're already seeing some of the impact of that this morning out of the employment report that shows a pretty big spike in unemployment claims, and we expect them to get even higher. That is the reality. It's something that the market has started to price in very quickly and already. The CARES Act that Grant talked about provides a lot of support for those individuals and those employees who are out of work at the moment, and a lot of spending to support the economy during this temporary shutdown. The Federal Reserve has also been very aggressive and has a very strong response in terms of reducing borrowing rates and their policy rate to nearly zero, and also buying bonds in the market to support both the financial system, but also the economy at large. Those were two big responses and important at a time like this. We think with that and with the natural progression of this particular situation, the economy will recover, although it will take time. And that really does have an impact on the way that markets behave and our investment strategy. So a quick comment on the market. Equity markets have stabilized to some degree. We're still seeing volatility, but the stimulus packages that we talked about are having some soothing effect to some degree. The point we really want to make, though, and this is really the key part of our conversation today, is it's really important to maintain a higher quality emphasis in your portfolios, and particularly the bond portfolios, which we talked about last week, but equity portfolios as well. And before we get into a conversation with Kim Scott, who's very kindly joined us from Ivy, I wanted to give you a little update on what's going on just in the market as overall as a background. First, the screen that you're looking at here is the S&P 500. This is a growth of $1 million back in 2010. There was a very strong and continuous bull market that helped $1 million reach nearly $3.5 million With this move in the last quarter, that drops down to 2.7 million. There's about a 20% decline in the first quarter, but the market reached a record high in February, just about a month ago. As has been the case for the last many years, growth companies have outperformed the value companies, and large companies have outperformed small. That has a little bit to do with this quality theme, and we'll talk a little bit more about that when we talk with Kim. Also, what's important about the quality theme is that it's typically sectors that are more defensive to an economic cycle. Healthcare, for example, consumer staples. And we found that technology today has provided very good, stable, and high quality earnings that is typically less sensitive to economic cycles than others. I think importantly, what we saw in the first quarter was a big decline, but we have seen some recovery. It's hard to see on this chart, but we are back above where we were in 2018, fourth quarter of 18. And that's important. And of course, balanced portfolios have fared even better than that. To get us through some of this period, we've reminded clients over the last many communications that Wescott's been making adjustments, actions in the portfolio to try to improve the quality effectively. So we do that in a couple of ways. First is the increase in large company exposure, and that's shown in the blue line here. And that blue line has gone from less than 50% to over 67%. So it's a pretty significant increase over the last 3 years in exposures to large companies. The second thing I wanted to highlight is the orange line, or the yellow line here, sorry, the yellow line, which shows the allocation to defensive sectors, meaning that healthcare staples and utilities in this case. And that has moved from about 16% all the way up to over 22%. With those adjustments, we've seen a marked improvement in a quality measure we look at, which is return on equity. Return on equity is a way of measuring a quality business. And we see that has moved up over the last 3 years as well, pretty significantly. And today, where we sit in our equity portfolio is with high quality names at the top, Microsoft, Amazon, Alphabet, which is a parent of Google, Comcast, and United Health Group. There are a lot of other names in our portfolio, of course, and a lot of other companies we're going to talk to with Kim. But I wanted to at least highlight that as a framework, because these adjustments have enabled us to weather this current storm, but also position us well, I think, for the future. So with that, I'm very pleased to have Kim Scott join us from Ivy Investments. A quick introduction to Ivy. They're located and headquartered in Kansas City, Missouri. Kim and her team manage a mid-cap growth fund. So that's basically investing in growth companies that are not mega cap and not very small, somewhere in between. They have $4.7 billion in this fund as at the end of February. They started this fund back in 2007. And we've been very pleased to have Ivy and Kim working for Wescott clients since 2010. So Kim Scott, Senior Vice President, a portfolio manager with Ivy, and has a great background in microbiology from the University of Kansas, could be very helpful in times like this. MBA in finance from University of Cincinnati, and a CFA charter holder. So with that, Kim, thank you for joining us.
Thank you, Mark. Happy to be here.
And I think, what we wanted to do today, Kim, given your experience and given where we are today, and your philosophy generally, maybe you can just start off by telling us for what you and your team are currently seeing in the economy and the markets, and really what your perspective is at this point in time.
Certainly. So we clearly are seeing a broad and deep downturn in the world economy, but specifically I'm going to talk about the U.S. economy and our framework at Ivy for what we're thinking about this year and then how we move beyond this year. We have a dedicated macroeconomics team, and our head of that team is Derek Hamilton. And he has actually gone through industry by industry and GDP for each of those industries by quarter to try to determine what we will see in terms of the progression of GDP over this year and into next year and in 2022. So, and for example, we will see the recreation industry broadly be a big zero in terms of any type of GDP productivity in the next, for this month certainly, probably into May, and then gradually recovering. So that's the sort of analysis that he has done as he's looked at each of these broad sectors. The first quarter is probably going to be down 4%, and these are quarter-to-quarter annualized numbers, and some of that weakness clearly comes because some of the largest areas of our country in terms of economic activity turned down early in the quarter, and that would be New York, parts of California. And then we get to Q2 and we see about a 21% quarter-to-quarter annualized decline in the economy. So as we go through April, May, and June, with April clearly being very, very negative, that's what the quarter looks like. And then potentially a recovery on a quarter-to-quarter basis starting in the third quarter with an 11% increase and another 8% increase quarter-to-quarter. And these are annualized numbers quarter-to-quarter. And at the end of the day, the year should be down about 2.5%. Now, we do have to take into consideration that these are a lot of moving targets, and probably the two key things we have to think about are, how small business funding rolls out. That's just something that we can't get wrong from a government and administrative perspective. And I know there have been some concerns about, is this ready to go? I did hear this morning that B of A has its loan portal up and running. So clearly there's starting to be some traction, but small business clearly needs to be helped. And this is because small business and medium businesses really have been the incremental fuel to this economic growth engine that we've seen over the past few years. And so supporting that part of the economy is very important. And also the variability that we'll see with expectations about the virus and the duration of its impact could change these numbers. But for now, we see things starting to get a little bit better in the third quarter. And 11% sounds like a big up number, but it's coming after we have a very big down quarter in Q2. Overall, if you look at where we should be at the end of the year versus last year in terms of absolute GDP dollars, down a little over 2%. But if you look at where we expected to be for the year pre-virus, we will be down 4% based on these numbers from what our expectations were early in the year. And while we see some growth next year as well, in the 2 to 3% range, we will not make up that 4% hole until 2022. So things will feel a lot better once we start seeing some positive numbers as we begin to recover from this. But it will be at this point into 2022 before we actually make up the deficit versus expectations for this year.
Right. And given, that's a difficult outlook of clearly in the short term, medium term. You do talk about recovery a little bit later to the extent we'll see. But maybe you can talk a little bit about how you manage a portfolio through that environment, and maybe even highlight some of the quality aspects of the way you do things, so we can get a sense of how you maneuver and how you manage through that process.
Well, from a high level, I would just like to say that we are a growth manager, and being a growth manager can involve taking risks. But we like to say we are a progressive growth fund managed prudently. So we always take risk management of our process very seriously, because we definitely want our investors to be able to participate in very exciting growth opportunities in what is a very dynamic U.S. economy. But we also understand that there are risks that come with that sort of investing. And so we mitigate those risks by investing in quality growth companies. And we look at these companies as those that have very strong business models and that are supported by very sound capital structures. So what does that mean in reality? It means that our companies are profitable, and our companies use leverage judiciously. So their balance sheets are not heavily indebted balance sheets, and they have profits as measured by gross margin, returns on equity, returns on assets that are strong numbers. And you know, we've always thought about that from a just an opportunity perspective, but also a way to manage risk, because these companies that have these stronger business models, these more profitable business models, clearly are productive companies, but they are also companies that are able to weather uncertainty a lot better than those companies that do not have these attributes in their businesses. And this chart is just very simply shows that, and this is since 2005, but we've had some interesting markets since 2005, companies that have higher gross margins and lower debt, lower leverage, gross margin on the left and the leverage on the right, have been outperformers in more difficult market times. And again, this just highlights that companies that have more profits because they have higher margins just have the wherewithal to weather uncertainty a lot better. And also their balance sheets are stronger, and they do not have the unfortunate situation of having to worry about liquidity. They are not as subject to credit markets becoming difficult as spreads widen out. These companies have they're able to service the debt that they do have. And in many cases, we own companies that have no debt whatsoever. And, you know, that's the best situation to be in when credit markets are in trouble. So just very strong evidence of, you know, a little bit more safety in higher quality companies as measured by, you know, in this case, gross margin and leverage. And we focus on those. I do want to add very quickly, though, that we focus on cash flow, and we look at the cash flow that a company can generate. And usually when you have these attributes of higher margins and lower debt, you end up with more cash flow. It's not that different for a company than it is for us as individuals. Everybody is a lot happier when there's more cash coming in than going out, and that is really what we focus on when we look at our companies. What kind of cash can they generate, and what is the trend in that cash?
No, thank you. I think you can see it in these graphs, but when there's a down market, you know, those with better positioned on the gross margin side and those with less debt on their balance sheet, they definitely hold up better. And that's really why, you know, Ivy is in the portfolio, and your philosophy makes so much sense in our portfolio. So participating in the growth opportunity, but also protecting, and we've seen that protection this year. Pleased to say that the portfolio is holding up pretty well this year relative to its competitors through the first quarter, and I think this has a lot to do with it.
Definitely.
So, you know, with that, maybe we can talk a little bit about the third question here, which is, you know, what are you doing as a team managing the portfolio today? And we heard from Carrie this earlier that some of our clients are using electronic signatures to sort of get through and do things a little differently. You own DocuSign in the portfolio. That's one example. Maybe we can talk a little bit about. But what individual companies and positions that are you investing in are doing well in this environment, and maybe actions you've taken as a result of the market volatility? That'd be really helpful, I think, for clients to understand.
Sure. I'll talk a little bit in general about the way we've been thinking about dealing in this environment. First of all, I will say that the integrity of our approach, which we execute very consistently throughout market environments is the basis of what we're doing. We continue to do that. And the fact that we have that approach has given us the breathing room to be able to some degree, let the dust settle. It is really never a great idea if you have a sound investing approach to just react to these environments. Clearly, if you have things in the portfolio where the environment is changing the investment thesis, one should probably do something about a position where a weak link might be developing. And we have taken a few of those steps, and maybe not even that it's a particularly weak link, but we might have found something now in this environment that is so much more interestingly valued versus what it was 2 months ago, and we may have been waiting for an opportunity to buy it, that we've reallocated some resources for that reason. But we have had the luxury, because of our high quality investing approach, to be able to weather this storm with many of our names, and just continue to manage the portfolio as we have. So in many ways, we have been letting the dust settle. That being said, we've taken some positions out of the portfolio, as I just spoke to, where we said, okay, we have a portfolio of great balance sheet companies. This one, a particular name, may not be as good as all the rest of them, so let's just move away from that now in this uncertain environment, and even make this an even, upgrade the quality just by that move. DocuSign is a great example of our approach, our key process and philosophy. Here we have a company that is a solid mid-cap growth company, developing a new approach to presenting and signing legal documents. And the market for this company is very, very large. And you just think of all of the documents that people have to have a legal signature on. And I think a lot of us are accustomed to using DocuSign maybe in a mortgage transaction, but this company does document signing across so many areas of our economy. They now are able to present documents across the entire value chain in a company, from signing a purchase order to ordering inventory, getting the inventory in, signing off on it. The government passed the IDEA Act last year, I believe, where a high percent, I think 80% of government documents have to be signed electronically by law in the near future, and DocuSign is supporting that with their own data center that they've built for the government. So just a tremendous company that is growing because of this ability to do legal documents electronically, and that will not get any less important, obviously, as we encounter these kinds of situations in our economy.
Yeah. And maybe sort of switching gears a little bit, another name in the portfolio that we talked a little bit about that's doing quite well in this environment is Telehealth. And maybe just real quick introduction of what that is and why they're doing so well.
Yeah, Teledoc is a healthcare teleservices company, and this company we've owned in the portfolio, I think, since last year sometime. And it's basically just being able. Mostly, it's been to reach out to physicians when you have non-acute situations that you need help with, and that can be helped via a conference call, a video conference call with the doctor. And again, here you have a potentially very, very large market of these types of healthcare occasions that can be serviced via a teleconference with the doctor. And healthcare organizations, managed care organizations are using this more and more because it's very cost effective. But again, here we have a situation in our economy, not only because of the reduced access as we all stay away from the hospital and the doctor's office unless we absolutely need to be there. You can visit your doctor versus Teledoc or other telehealth services. But support from the government has increased through the CARES Act in order to encourage people to use this type of telehealth service to prevent the spread of the virus unnecessarily. And I think this just continues to justify the importance of this company and a new way to operate in our economy.
Yeah. And then a final quick question here, just bring it way down to sort of what everyone can maybe understand, but Chipotle is a holding that you own.
Yes.
And Grubhub is something that you had in the portfolio until recently. Maybe you can talk a little bit about those things and your actions there.
Sure. So, restaurants are one of the most challenged sectors of our economy right now. Essentially, many are shut down, but it is considered an essential business. And if you have a business that has a critical mass and has, as Chipotle does, the opportunity to continue to service customers through really their digital efforts. They've invested over the past 2 years in a very strong digital outreach through an app, through delivery, through pickup at their stores. And this investment is serving them very well. They are able to be open and allow people to order online and pick up or have delivery. And this, Chipotle is a very high quality company. Now, Chipotle clearly went through a lot of issues of its own making. We fortunately did not own the stock during that time, but we felt very strongly about what an important, strong concept this is. And with new management and a new approach to managing the business, they've come out of those problems very strongly. This is a very cash generative, very profitable business. And this is one of those companies that while we have a strong position in our portfolio, as we've seen any weakness here, we have added a little bit more to the portfolio. Conversely, Grubhub, while it is a technology platform for managing pickup and orders and delivery orders across the restaurant sector, that is a company that was already having some challenges because of competition prior to this virus issue. But Grubhub serves so many restaurants that are really just not operating at all right now, and we think their business would be very challenged throughout this environment, and it is just not as interesting as something like Chipotle at this time because of those challenges.
Fantastic. No, I know we went around the portfolio a little bit there, but we think that your perspective on the economy, your philosophy of highlighting growth companies and quality companies at the same time, those examples are great illustrations of what Ivy and Kim and your team do for our clients. So we appreciate your insight there.
Thank you, Mark.
And with that, I'd like to turn it back over to Grant with some closing remarks.
Thanks, Mark. Well, actually, your key takeaway, what you just summarized were the key takeaways. I don't think I need to repeat them, but what I will repeat is my appreciation to Kim for all the hard work that she has done and her team has done for this decade. And it is times like these that the active management that we have in our portfolio, that complements our passive management in the portfolio, really shines, both in terms of uncovering opportunities, rotating a portfolio from something where there's less conviction to something where there's more, and to address risks and new risks that are in the portfolio. So we greatly appreciate your efforts on our behalf. And Mark, thank you so much for the perspective on portfolio overall. We keep doing these. We will continue to do the webinars. We will continue to take select parts of the portfolio and dig into them with you and make this as transparent for you so that our clients continue to have the fortitude in what is a very trying market, but also trying time in terms of a pandemic that's going on and has its own threats to our own personal safety. So with that, I say we'll look forward to our next presentation from our team here. To your family, please continue to be well and safe. Please don't hesitate to reach out with any questions, and we won't hesitate to be reaching out to you. Thanks very much for joining us.